The Dow Jones Industrial Average closed above 50,000 for the first time ever on Friday. The Dow Jones, of course, kind of gets it's seen as a second string player because people note that its construction is rather odd and it has just a few stocks. But let's get more on that benchmark and the latest in the markets. We're joined by Szytel, Co-Chief Investment Officer at the Bahnsen Group. Thanks very much indeed for joining us.
Thank you.
I think at one time, when people used to phone their brokers in the old days, they'd say, how's the Dow? But you don't really hear much talk about the Dow Jones average these days, mostly about the S&P 500 and the NASDAQ.
That's true. You know, the Dow is a price-weighted index. S&P is cap-weighted. It has 500 names in it, and so it's a broader index. That said, it has become so overvalued in the technology sector now. It's about 40% or so in tech and communication services stocks.
Wow.
That the Dow is actually still a good barometer to take a look at what the underlying economy is doing.
That's interesting. Yeah, we kind of forget that it's not just railroads and steel companies. They have kept up with the modern economy, loading it up with tech stocks.
That's true. And what you've seen in 2026 year to date is this continued rotation from some of those tech parts of the market into more of the value-oriented components. And so the Dow is actually outperforming the S&P 500 by a wide margin on the year. And I suspect that isn't the ninth inning, but more closer to the first or second inning here as we progress through the remainder of the year.
What is your feeling about the broad market, Brian? Obviously, there is a bit of a chill wind blowing through these software stocks. Start off with them. Are you seeing value there in traditional names such as Adobe, for example?
We do see value there. I mean, the software names have really gotten pummeled with Anthropic and Claude and their Opus One 4.6 release and what they may do to some of those business models and take some of the market share. But if you look at the software services businesses, they've gone from about 35 times earnings all the way down to about 23 times earnings in about a month and a half. So they're on sale. I don't think those business models will be completely supplanted by what AI may bring. And so there's value in the space, no question about that.
You are seeing a continued rotation here. One feature of that from growth to value stocks?
That's true, and a lot of that is just valuations. You know, valuations were very high in the tech part of the market and the growth part of the market. Small caps had underperformed for a very long time, and so you're seeing that rotation continue to unwind here in 26, and I think that is something that will be an ongoing theme here as we progress throughout the remainder of the year.
So you do say there's froth baked into the market. However, the outlook for profitability pretty good. I mean, company earnings have been great, and we're going to get tax cuts, et cetera.
And those are all bullish statements, you know, and that's why there's a tug of war right now in markets. It's about all of the good things that may be happening. We've got expanding PMIs and ISM services and manufacturing data, coupled with a weakening labor market. And then, like you've said, some deregulation and some tax refunds that are going to come on down the pike here in the next couple of months. So there's a back and forth, and what it ultimately is coming down to which part of the market is reasonably priced versus which part may be a little overdone. And there's still a question mark around what AI productivity may or may not bring and what the ROI actually is associated with that.
What about the hundreds of billions of dollars? We're up into the trillions of investment in hardware, essentially. I know some of it's software as well, though, to provide cloud computing driven by AI. Does that a smack of a bubble as far as you're concerned?
I think there's components of it that could be bubblicious, I'll call it. But that said, you know, there's a question mark on ROI to that stuff. And by any metric, on any calculation, it's a very long time period before there's actually profits associated with that amount of money spent on it. And so, again, it comes down to what you're paying for these companies, what's already priced in, and what's more realistic from a business model perspective. Those big tech companies can afford the investment. So that's not at all what I'm saying. But it's, you know, to be seen as far as the actual return on investment.
It's interesting. I mean, Amazon striking a deal to get copper from a mine, a Rio Tinto mine in Arizona. It's come to that, where Amazon feels it needs raw copper.
That's true. I mean, this is an energy and a commodity associated benefit from a lot of the data center capex that has gone into AI, and all of those things are relevant in today's market, which is why this is touching most sectors in the market. And from our vantage point, focusing on those industrials, those energy names, some of the staples, the defensives that have frankly not participated quite as much, is a better way to play some of this expansion here into 26.
One company that's catching your eye is Blackstone, BX, a huge in the alternative investment space.
That's true. It's a behemoth. It's best of breed. It's got a 365 yield on it, so you're getting paid while you own it. It's a bit of a baby thrown out with the bathwater here. A lot of those alternative managers have sold off alongside some of the software sell-off because a lot of them are financing, those businesses in the form of private credit. That said, I do think there's value in the name. It's growing distributable earnings at about 18% a year, and is trading under a market multiple at this point. And so I think you can scoop up shares of Blackstone here.
You feel there's a cloud over private equity because of worries in the private debt market?
Not necessarily on the private equity. Those two things I would treat differently. When you have bank covenants and ratios calculated in software businesses that have 45% margins in them, and then you have other businesses that are going to take market share, that can be a risky play. There's also a higher level of payment in kind in the private credit market associated with software businesses. And so that's why you've seen some of the weakness in the alternative managers. But that all said, Blackstone is a hyper-diversified business with real estate, credit, and private equity. And you're getting it on sale here for, like I said, best of breed in the space.
Thanks very much indeed for joining us this morning, Brian.
Thank you.
Brian Szytel, Co-Chief Investment Officer at the Bahnsen Group.